one thing I think we can really get out of the 70s, though, is the energy situation. So in the 1970s, domestic U.S. oil production peaked in 1970. So you had that money supply growth and that demand growth combined with a very real supply constraint. And so the United States became more reliant on foreign imports, obviously. That opened us up to geopolitical risk and scarcity. And so I'm finding a similar environment today where energy is the bottleneck for a variety of reasons. But then the monetary and fiscal side looks generally more like the 40s than the 70s. And again, these roadmaps are not perfect, but I feel like if people are unfamiliar with history and are unable to identify the similarities and differences between those periods, then they're kind of totally flying blind, and they're going to view a lot of things as unprecedented and confusing when we have examples of history that we should at least be.
The Fed is all set to take a step which could bankrupt all the major banks in the U.S. That's what LYN Alden, the founder of LYN Alden Investment Strategy, said, which literally gives goosebumps to the major banks. And when banks go bankrupt, perhaps there will be a financial crisis in the U.S. These banks have been keeping the U.S. balance sheets running. Without them, things might cease. So what is the Fed thinking that can bring down all the banks in the U.S. like a domino falling? LYN Alden says that if a condition is met, then it is certain the banks in the U.S. would go bankrupt. Let's listen to her and find out what that indicator LYN Alden is talking about. Generally, the economic era is divided into two sections. One, in which the economy does great and brings in more capital for the country's reserves. In this case, the country takes the money from the economy and stockpiles it in the reserve for bad times. At the same time, this also brings inflation down, making the currency more valuable than it was earlier. However, in the second period, the economy does badly, and the country finds it hard to keep the economy running. It has to take debt from its private and foreign banks, so the economy can stay on track. In this case, either the country can use the capital from its reserves, if it had saved, or the country can have loans, as we talked about. However, countries like the US usually don't get debts from foreign banks and other countries. Instead, they are indirectly indebted to their private banks and treasury bond buyers. Treasury bonds are launched, which investors buy, and this gives the country enough capital. On the other hand, a country like the US can print more money to keep the account sheets balanced. Since the USD is an international currency, it doesn't bring much tension for the US to print more USD and cause inflation. Rather, inflation almost stays the same. However, it should be noted that instead of taking debts from one or two countries, the US chooses to divide them into hundreds of parts. In other words, it takes loans from thousands of parties, or whoever buys its bonds. Asterisk, here's a little reminder to like the video if you were loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. Asterisk, now, when bonds are released and more money is printed, the government ensures that these two elements stay safe. In other words, the Fed ensures that the bond market doesn't fall no matter what happens. And it also ensures that the newly printed money is pumped into circulation by offering low interest rates. Now, if the bond market falls, the US will go bankrupt because these bonds mean US divided debts. The inability to pay returns means the US is bankrupting on its debts, right? Therefore, when the bond market gets into trouble, or only a few parties are buying the US Treasury bonds, the Fed has to come forward and buy them. If it does not buy them, the market will be drained by them, and thus, the US economy will fall. However, in order to buy bonds, a large sum of capital must be used. Now things start to go exactly the opposite. Earlier, the Fed was offering loans at low or zero interest rates because it had surplus currency. However, now it cannot print more money because it is already having difficulty in maintaining earlier debts. In this situation, the Fed doesn't have surplus capital, and thus monetary policy is tightened. Interest rates are raised so that having loans becomes expensive. All this is due to a lack of capital. That's where the major banks come into play. They hate when interest rates are raised. But why? Well, you will know about that within a few minutes. But first, listen to what LYN Alden said about the similarity between today's time and the 1940s and 1970s.
The reason I use the 1940s is because that was essentially the last time we had, this kind of 1-2 punch popping private debt bubble, which was in the 1929 crash, and then into the 30s, we had a collapsing private debt bubble. Interest rates hit zero for the first time in a long time. And then we started to get rising populism. And then that rising populism contributed to global war, which then resulted in a huge fiscal response. And so the 40s, after disinflation in 1930s, the 40s were very inflationary. And that money creation wasn't from bank lending, it was from fiscal spending and the central bank monetizing that spending. And so if people ask, I got the question before, if I didn't know there was a virus and I just looked at charts today, what would I think is happening? I would describe it as wartime finance. That basically, we had a similar popping of a private debt bubble in 2008, 2009. Then we had a decade of relative stagnation. It wasn't as bad, obviously, as 1930s, different technology, different monetary policy, no Dust Bowl, obviously, there are a lot of differences, but we had this kind of stagnating period, rising populism. And then, of course, we were hit by the pandemic. We had a war-like fiscal response to it. And then now we actually have the breakout of some degree of kinetic war. And so I view the 1940s as the closest parallel. It's also the only time in U.S. history where sovereign debt as a percentage of the economy is as high as it is now. And so we saw a very different response to that inflation from the central bank compared to what we saw in the 70s. And so overall, I think that's the closest environment. There are some differences, though. So, for example, back then, the United States was kind of in China's position. It was this rising emerging market. We were a net exporter. And so in many ways, the United States looks more like the UK did in the 1940s, if we were to be more precise with that analogy. But then even then, of course, there are multiple technology differences, demographics differences, structural differences that make this period different. And when people think of inflation, they often think of the 70s. And that's the one that I try to somewhat shy people away from, because in the 70s, that inflation was very much driven by bank lending and demographics. Basically, the baby boomers were entering their home buying years. And so you had a ton of building construction. You had a lot of bank lending. That's where a lot of the money supply growth is coming from. Of course, there was a fiscal overlay on top of that, the whole guns and butter program. And so that was a very inflationary environment. But it was different. So they were, debt was low. They were able to raise rates to deal with it. Just a very different environment than the 40s and that we have today. The one thing I think we can really get out of the 70s, though, is the energy situation. So in the 1970s, domestic U.S. oil production peaked in 1970. So you had that money supply growth and that demand growth combined with a very real supply constraint. And so the United States became more reliant on foreign imports, obviously. That opened us up to geopolitical risk and scarcity. And so I'm finding a similar environment today where energy is the bottleneck for a variety of reasons. But then the monetary and fiscal side looks generally more like the 40s than the 70s. And again, these roadmaps are not perfect, but I feel like if people are unfamiliar with history and are unable to identify the similarities and differences between those periods, then they're kind of totally flying blind, and they're going to view a lot of things as unprecedented and confusing when we have examples of history that we should at least be aware of to help guide us. So I factor that heavily into my analysis as it pertains to this current euro-dollar, petrodollar system compared to the Bretton Woods gold standard system, because now the treasury is at the heart of the global financial system rather than gold. That's the biggest difference. And so that's been a strong catalyst to force the U.S. to run these structural trade deficits and to have these, the positive flow of foreign capital into U.S. markets, and then our subsequent reliance on that engine continuing, and the harms that come from having that engine continuing, because it's not a purely one-way street. Basically, we kind of draw down our manufacturing base to some degree in order to have these stronger capital markets, which is, I think, a contributor to the rising populism that we're.
Now let's come to that question. How does raising interest rates hurt banks? Try to think about how the banks make money. You might think they charge us fees in return for the transaction and other financial services they offer. Sure, they do make money that way. However, that's not their entire business. They make most of their money by offering loans, credits, debts, whatever you may call it. When they offer loans, they charge an interest rate. Wait for a second. If they make money from interest rates, shouldn't high interest rates help them make more? Well, the logic says this, however, we are talking about consumers' behavior. When interest rates are increased, people find it hard to have loans because they have to pay high interest rates. Therefore, even if high interest rates are more profitable for banks, they are less helpful. Fewer people would take credit and loans when interest rates are high, and this will shut down their business. However, the Fed cares little about the banks because it wants the capital to stay in banks and not be spent by the people. It would help if the money were people's own, but they are taking loans, right? And the Fed doesn't have the capital because it's already lagging on its treasury bonds and debts. This becomes the point where Fed and banks' interests diverge. If one will have benefits, the other has to compromise and perhaps face the worst. Now, as we already told you, the Fed doesn't have capital and doesn't want people to have loans. That's why it's rising interest rates. According to economists, it has been doing so, and this will keep happening. But the banks don't want that. If interest rates go up, people won't take loans from banks and will go bankrupt. When interest rates are increased, the economy is deliberately slowed down, which was bearable in the past. However, today, banks cannot afford to have their business shut down. That's why if the Fed buys back the U.S. Treasury bonds and increases interest rates further, major banks in the U.S. will go bankrupt. Listen to what LYN ALDEN said about that.
We're seeing today. Going back to the Bretton Woods system, although that was a large change, one thing I would actually argue is that the financial system changed substantially decades prior to that. And that was actually the more fundamental change. So by the time you got to the 50s and 60s, for example, even though the U.S. was officially still on this international gold standard, gold was not a constraint for bank lending. So money supply was growing dramatically, despite the fact that gold in the vaults of the Treasury was, declining that whole time. They're basically banks. They never had a pile of gold that they checked and said, "Do you have enough gold before you can make this loan?" They didn't have that constraint at all. So you already had a complete separation from the whole process of money creation and gold. That got marked to market in the 1970s. But that was already decoupled for decades leading up to that. Whereas I think the more fundamental changes happened decades earlier when you moved from free banking to central banking and then increasingly abstracted the gold away from the whole process. So gold went from the banks to the central bank and then went from the central bank to the Treasury. And it just got removed from the whole money creation process, even when we were still on a gold standard. And that's part of the reason why we ultimately lost the gold standard, is because the gold was no longer a practical constraint on money creation. Even the foreign sector, foreign central banks could create dollars essentially by lending. And that's, the whole euro dollar market grew around the gold market. And so you had this increasing number of dollars and foreign claims on dollars, and those were foreign claims on gold. And eventually the United States severed that connection. And so that was just marking to market a problem that was already in place for the, pretty much the whole duration of the Bretton Woods system. I think that's an important distinction, especially as it relates to the differences in trade deficits between the United States and the UK. Like I said before, I think the United States looks more like the UK from the 1940s than it looks like the United States from the 1940s. So it factors in that way, but I don't think it really factors too much into the monetary.
Do you think the Fed will make the mistake of raising interest rates? Or will it have to buy back the U.S. Treasury bonds to keep the bond market running and prevent a collapse? If it does so, it will inevitably harm banks in the U.S., and perhaps it will have to declare bankruptcy then. Comment right below in the comment section. Has the U.S. and Fed got any option to escape their dilemma? Do you want to watch more videos like this one? If yes, please like and share the video, and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.